Brett, because Mike mentioned breadth in the market, I know it's one of the things that has caught your attention. The market has been, by most measures, pretty narrow. Large cap, big tech, mega cap stocks have driven the indexes to where they are. But you think that may change in what you see as the dawn of not a new era, but a bit of a transition in the market. Explain why.
Yeah, I think there's a dawn of a new economic cycle. And so I don't think we're going to get out of this without a recession. I still think one is likely in the future because I don't think inflation breaks without one. We've been kind of stuck in this narrative of those large cap names doing well. And I think Michael mentioned momentum. It certainly is a powerful tool that people gravitate towards because on Wall Street, we all have to put money to work on a daily basis. And so people have gone to those more seemingly economically resistant names like those big tech companies. But I think when you see the opposite side of this, when you see interest rates come lower after a recession, I think for investors who think 12, 18, 24 months out in the future, I think there's opportunities for the market to broaden back out and bring in things like small and mid cap, which trade at 14, 15 times earnings, and even parts of the S&P 500 beyond those top 10 names, which trade for 15, 16 times earnings. And so to me, you can't keep having a market this narrow, an economy this narrow, without either the economy re-strengthening, causing those names to go up, or a recession.
I want to come back, Brent, to this thesis, which seems like a critical one of which cracks first, the economy or inflation. But before I do that, back to you, Mike. How does Brent's thesis strike you? In other words, that once interest rates start to fall after a short recession, once interest rates start to fall, the favorable signs will be sort of towards the mid and smaller cap stocks, not the biggies.
Yeah, I think that kind of a reset would be pretty much textbook if we were going to, be at that point in the cycle. I just don't know if it's a foregone conclusion that we are, or that we would wait for it, or from what level we'd be rising, if you're a small and mid cap. So I think it does make sense. I think I'm more just looking at, the direction of change in yields has tended to determine whether, in fact, smaller stocks and the average stock in the S&P get some relief or not. And so, the market plays defense against higher yields in some ways by going to the very well-defined themes and those companies impervious to a lot of the macro. So I'm more observing than predicting that that's going to be the way.
So, Brent, why don't we go back to that thought? You think the economy will crack before inflation does. Why are you persuaded that way?
Because I don't think the Fed's going to be able to cut rates, and the longer that rates remain elevated, the more they work their way into the economy. You're seeing that at the lower-end consumer, where they've run out of excess savings, and they're now feeling the pain of credit card and auto loan debts. I think eventually, because the Fed leaves rates higher, I do think it continues to work its way into the economy. And we should all remember that on average, it takes 10 quarters for interest rates to impact the economy, at least in the prior times the Fed has hiked, and we're only 9 quarters into this. And so we're not out of the historical norm for how long it takes to filter in. And I think you had an economy that was kind of built up against that. But now you're starting to see it's work through. And I think that's where you eventually get a recession because the Fed won't be able to cut rates. And I think kind of tying into Mike's comments, if we're wrong, if the economy does broaden out, if the Fed can cut rates, I think that's where you have optionality in small and mid. And you can win longer term on valuation in both instances.